Picture two people, both 32 years old, both responsible, both doing exactly what they were told to do with their money. The first person has $25,000 sitting in a standard savings account at one of America's biggest banks. She checks her balance every month and feels good. She's being safe. She's being smart. She's saving. The second person took that same $25,000 and put it somewhere her bank never mentioned. Not stocks, not crypto, not anything risky, just a different type of account, one that actually exists at federally insured institutions across the country. After 5 years, the first person's $25,000 has grown to $25,012.50. $12.50. She could barely buy lunch with the interest her bank paid her. The second person, her $25,000 grew to $31,940. Same 5 years, same $25,000, same level of risk. A $6,928 difference, created entirely by what her bank chose not to tell her. This isn't a story about investing. This isn't about the stock market or taking risks. This is a story about the most legal, most sophisticated, and most invisible theft happening to American savers right now, happening inside the institution you trust most with your money. Today, I'm going to show you exactly how your bank profits from your financial ignorance, what they do with your deposits the moment you make them, and the specific accounts the banking industry hopes you never discover. If you've ever looked at your savings account statement and felt like the interest payment was almost insulting, like the bank was mocking you with that 43 cents, this video is going to make a lot of things click into place. My name is Rick, and I spend way too much time thinking about the systems that quietly drain wealth from people who are trying to do the right thing. The savers, the responsible ones, the people who did everything they were told and still can't figure out why it doesn't add up. If that sounds like you, hit that subscribe button and give this video a thumbs up, because what I'm about to show you isn't controversial. It's documented, it's public record, and yet almost nobody talks about it because the people who profit from your silence have billions of dollars in marketing budgets to keep you distracted. Let's get into it. Section 1. The spread. How banks actually make money. To understand the scam, you first need to understand the business model. And once you see it, you cannot unsee it. When you deposit money into a savings account at a major bank, Chase, Bank of America, Wells Fargo, that money doesn't just sit in a vault with your name on it. That's not how banking works, and it hasn't worked that way since the Federal Reserve was created in 1913. Your bank takes your deposit and immediately puts it to work. They lend it to other customers as mortgages at 7% interest. They invest it in Treasury bonds yielding 4.5%. They fund business loans charging 6%, 8%, even 10% to commercial clients. Your bank is running a financial business with your money. They are the fund manager. You are the unwitting silent partner. And here's the number that should make your blood pressure rise. In 2024, the Federal Reserve's benchmark interest rate, the Fed funds rate, averaged over 5%. That's the rate at which banks can lend money to each other overnight. It's the floor on which the entire interest rate economy is built. That same year, according to the FDIC, the national average interest rate on a standard savings account was 0.46%. Let me say that again. Banks were earning opportunities of 5% or more with your money, and they were paying you 0.46% for the privilege of using it. That gap, the difference between what your bank earns and what it pays you, is called the net interest margin, and it is the single most profitable line item on every major bank's income statement. JP Morgan Chase reported net interest income of $89.3 billion in 2023. Wells Fargo reported $52.4 billion. Bank of America, $57.5 billion. You might be thinking, Rick, banks have expenses. They have branches, employees, technology. Of course they need to make money. And I hear you. Banks are businesses. They're entitled to a profit. But here's the question nobody asks. How much of that profit is coming directly from the gap between what they earn and what they pay you? And, more importantly, did you agree to that deal? Did anyone explain it to you when you opened your account? Or did they just hand you a debit card and a tote bag and hope you never thought to ask? Section 2. The math of what you're losing. Let's run the actual numbers because this is where it gets real. The median American household has approximately $8,000 in savings, according to the Federal Reserve's 2022 survey of consumer finances. Let's use that as our baseline. At 0.46% annual interest, the national average for standard savings accounts in 2024, that $8,000 earns $36.80 per year, about $3 a month, less than a cup of coffee. Now, here's where it gets worse. Inflation in 2024 averaged approximately 3.2%, according to the Bureau of Labor Statistics. That means the purchasing power of your $8,000 is declining by $256 per year in real terms. You earned $36.80 in interest. You lost $256 in purchasing power. Your net position? Negative $219.20. You are losing over $200 a year by doing the responsible thing, by saving money, by following the advice your parents gave you. But wait, it gets worse. That $36.80 you earned, the IRS considers it taxable income. At a 22% marginal tax rate, you owe approximately $8.10 in federal taxes on your interest. Now your actual after-tax, after-inflation result from a year of responsible saving is approximately negative $227. You are being taxed on money you effectively lost. And here's the number that should haunt you. Over a 30-year working career, the average American who keeps $10,000 in a standard savings account instead of a high-yield savings account earning 4.5% will miss out on approximately $50,000 in interest earnings from the same money, the same institution type, the same federal insurance protection. $50,000 gone. Not because of bad investments, not because of market crashes, because nobody told you which box to put the money in. Section 3. The mechanics of the deception. Now you might be asking, if high-yield options exist, why doesn't my bank tell me about them? This is the part that turns information into outrage. Major banks have a structural incentive to keep you in low-yield accounts. Here's why. When you put $10,000 in a standard savings account paying 0.46%, the bank pays you $46 per year. When they lend that money at 7% on a mortgage, they earn $700. Their profit on your deposit? $654. If you moved that same $10,000 to a high-yield savings account at 4.5%, the bank would pay you $450. Their profit on the same deposit, $250. Your gain, $404 per year. Their loss, $404 per year. That is precisely why your bank's mobile app defaults to showing you their standard savings accounts. It's why their tellers are trained to promote checking and savings products. It's why the high-yield options, even when offered by the same bank, are buried 3 menus deep in the website with zero marketing support. It's not an accident, it's architecture. Let me introduce you to someone who learned this the hard way. His name is Marcus, and he's 41 years old. He works in logistics in Columbus, Ohio. Spent his entire adult life doing what he was told, maxing out his checking account because it was convenient, keeping his emergency fund in the savings account his bank opened for him automatically when he was 22. Marcus had $18,000 sitting in that account for 4 years. He earned $332 in interest over those 4 years. His account statements showed green numbers. He felt responsible. Then his coworker, a woman named Denise, mentioned she was earning over $900 a year on $20,000 in an account she opened online in 15 minutes, fully FDIC insured, at a bank she'd never walked into. Marcus looked it up. He moved his money that weekend. He didn't need a financial advisor. He didn't need to take on any risk. He just needed someone to tell him the options existed. That's what this video is. Section 4. The products your bank hopes you never find. So let's talk about the specific alternatives that exist in the financial system. The ones that are legal, federally insured, and available to any American with a social security number in 15 minutes. High-yield savings accounts, HYSAs. These accounts work identically to a standard savings account. Your money is liquid, meaning you can withdraw it at any time. They are FDIC insured up to $250,000. The only difference is the interest rate. In 2024, major online banks like Marcus by Goldman Sachs, Ally Bank, Marcus, and SoFi were offering rates between 4.5% and 5.1% on their high-yield savings accounts, versus the 0.01% to 0.46% offered by traditional brick-and-mortar banks. You might be thinking, online bank? Is that safe? And I hear you. This is the concern that traditional banks love, by the way. They invest significantly in making online-only feel risky when it is not. Online banks are regulated by the same federal bodies as traditional banks. They carry the same FDIC insurance. The only thing they don't have is expensive real estate on every corner. And those branches? That infrastructure is paid for by your interest earnings. The online bank passes those savings directly to you in the form of higher rates. Treasury bills and I-bonds. The United States federal government issues debt instruments that individual citizens can purchase directly through treasurydirect.gov, a website run by the U.S. Department of the Treasury. In 2024, 3-month Treasury bills were yielding approximately 5.2%. These are obligations of the federal government itself, arguably the safest financial instrument that exists on planet Earth, backed by the full faith and credit of the United States. Series I savings bonds, I-bonds, are inflation-adjusted government bonds that were paying over 6% annually during the inflation spike of 2022. They're capped at $10,000 per person per year and have a 1-year lockup period, but they represent a direct government-to-citizen savings mechanism that bypasses the banking intermediary entirely. Your bank does not advertise these products. Your bank cannot profit from these products. Therefore, your bank will not mention them. Money market accounts and CDs. Certificate of deposit accounts, CDs, offer fixed interest rates in exchange for locking your money up for a defined period. 12-month CDs at online institutions in 2024 were offering rates between 4.8 and 5.3%. Traditional banks were offering 0.5% to 1.5% for the same product. The money is federally insured. The term is defined. The difference is purely which institution you trust with the deposit. Section 5. The systemic design. Here's what takes this from frustrating to infuriating. This isn't an accident of the market. The disparity between what traditional banks pay savers and what is available elsewhere is a feature, not a bug. Research from the Consumer Financial Protection Bureau has documented what economists call deposit rate stickiness, the phenomenon where banks are quick to raise loan rates when the Fed raises rates, but extremely slow to pass those increases on to depositors. When the Federal Reserve raised rates from near zero to over 5% between 2022 and 2024, the average mortgage rate in America followed almost immediately, rising from 3.1% to over 7%. Homebuyers felt it within months. The average savings account rate, it went from 0.06% to 0.46%. That's not proportional. That's not a coincidence. That's institutional behavior designed to capture the maximum spread between borrowing costs and deposit payouts during a rising rate environment. A 2023 academic study published in the Journal of Financial Economics found that large banks, those with over $100 billion in assets, pass through less than 20% of Fed rate increases to their deposit holders. Smaller community banks pass through closer to 40%. Online institutions competing for deposits without physical infrastructure costs often pass through 80 to 90%. The bigger the bank, the better your relationship with their marketing team, the worse your relationship with their interest rate desk. Section 6. The psychology of inertia. So why don't more people move their money? The math is obvious. The alternatives are accessible. The process takes 15 minutes. Why does the status quo persist? The answer lies in something behavioral economists call default bias, the human tendency to stick with whatever option we were automatically enrolled in, even when better options are available and switching costs are low. Research from Harvard Business School has documented default bias across financial products, retirement accounts, insurance selection, and savings rates. The consistent finding, the majority of people, regardless of education or income, remain in the default option even when switching would clearly benefit them. Banks understand this research extremely well. They use it actively. When you open a checking account, the bank automatically opens a savings account alongside it. That account has a rock-bottom interest rate, but it's linked to your checking. It's convenient. It has your history. Your direct deposits are connected to it. Your autopay is set up through it. The switching cost is not financial, it's psychological. It's the friction of calling a new institution, waiting for verification, setting up a new login, updating your direct deposit. That friction, which takes perhaps 2 hours of your life, is worth $404 per year on a $10,000 balance every year forever. Most people never make the trade. The banks know you won't. They're counting on it. Section 7. The complete picture. What the math looks like over a lifetime. Let's bring this home with a final comparison that puts it all in perspective. Two colleagues, same company, same salary, same financial habits, both diligent savers. Alexandra keeps her $30,000 emergency fund and short-term savings in a standard savings account at her primary bank for 20 years. She earns an average of 0.5%, generous actually by historical standards for traditional banks. Over 20 years, her $30,000 grows to $33,161. She earned $3,161. Her colleague Jennifer does exactly one thing differently. She opened a high-yield savings account at an online institution and moves her non-investing cash there. She earns an average of 4% over the same 20 years, conservative given the 2024 environment. Her $30,000 grows to $65,734. She earned $35,734. Same $30,000, same 20 years, same federal insurance protection. Alexandra earned $3,161. Jennifer earned $35,734. The difference is $32,573, created entirely by where they stored identical money. Jennifer did not take on more risk. She did not make better investment decisions. She made one 15-minute decision that Jennifer's bank hoped she'd never make. That's the scam. Not a guy in a trench coat, not fine print that requires a lawyer. Just information asymmetry, default bias, and a financial industry that profits from the gap between what they know and what they tell you. So what do you actually do? Here's the practical framework. Step 1. Audit your current accounts. Log into your bank right now. Find the interest rate on your savings account. If it's below 1%, you are actively losing purchasing power every year you leave money there. Write down your current rate. That number should make you uncomfortable. Good. Let it. Step 2. Open a high-yield savings account. This is not complicated. Go to Ally, Marcus by Goldman Sachs, SoFi, or Discover's banking division. None of these are recommendations. Do your own research. Compare current rates at a site like Bankrate or NerdWallet. The process takes 15 minutes. You will need your social security number and a bank account for the initial transfer. That's it. Step 3. Decide what goes where. Your operating money, the cash you need for bills this month, stays in your primary checking for convenience. Your emergency fund, your down payment savings, your short-term savings, those move to the high-yield account. The money you need to access quickly stays accessible. You just stop letting convenience cost you thousands per year. Step 4. Look at Treasury Direct. If you have savings you won't need for 90 days or more, go to treasurydirect.gov. This is a U.S. government website. Create an account, look at current T-bill rates. You are lending money directly to the federal government and collecting the interest yourself, cutting the bank out entirely. Step 5. Never look at this passively again. Check your savings rate annually. Interest rate environments change. The best rate in 2024 is not necessarily the best rate in 2026. 10 minutes once a year is the only ongoing maintenance this requires. The system isn't going to change because you deserve better information. The bank isn't going to call you and suggest you move your money. The only person who will fix this is you. You now have the information. The question is whether you'll act on it. The woman who moved her $25,000 from a standard savings account to a high-yield account, she's not a financial expert. She's not wealthy. She didn't have a mentor on Wall Street. She just watched a video like this one, spent 15 minutes on a Tuesday afternoon, and added nearly $7,000 to her net worth over the following 5 years by doing absolutely nothing else differently. That's what this channel is about. Not get-rich schemes, not market speculation, just the information that the institutions with the most to gain from your ignorance will never voluntarily provide. If this video opened your eyes to something that was hiding in plain sight, hit that like button and subscribe. Every week we expose another system that costs the average American money they didn't know they were losing. And if you want to see exactly how your paycheck is being taxed before it reaches you in ways most people have never calculated, that video is right here. This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a qualified financial professional before making financial decisions. I'm Rick, and they never taught you this in school. But now, you know.